In 1951, a 21-year-old Warren Buffett went to meet one of the vice presidents of Geico and then invested in the company. The reason why he invested in the company, why he went to meet that vice president, was because his mentor, Benjamin Graham, was also investing in the company. Actually, Benjamin Graham owned 50% of that company. Like any other investors, Warren Buffett was looking at what other investors were doing. And this is something that even we do today. You're watching this video. If I tell you that I'm investing in a company, most probably you're going to look at this company, and if you like it, you will invest in this company. And I also collect ideas from other investors, great investors, and even from you. Sometimes you make suggestions. If I like it, maybe I will look at the companies and invest in them. One investor that has affected my investments in recent years would be Michael Burry. And the main reason why our investments sometimes look so similar is because of our way of thinking. Both of us like deep value stocks. And I can give you a few examples of stocks that he has invested in that I also considered investing or invested in. The most important one would be GameStop. I invested in this company in 2019, and Michael Burry was also investing in the company. And in some way, because of that letter he sent to the board of GameStop, it convinced me to increase my investment in GameStop. Another example will be GEO Group, which I have currently in my portfolio. But the stock I really want to talk about today will be Qurate Retail. This is not a stock I'm investing in, but it is a stock I have been following since last year. I did not invest in the company. I made the right choice because the company since last year is down 72%. Earlier this year, in August, I looked at the company again and I decided not to invest in the company even though it looked undervalued. I did not invest in the company and the stock price crashed a further 40%. But Michael Burry is investing in the company. So you see, I did not get this idea from him. I don't know if he got the idea from me. But because of our way of approaching the stock market, sometimes it happens that the stocks we are following or investing in are going to be the same. So why do I say that I'm not going to invest in Qurate Retail and that maybe Michael Burry is making a mistake with this company, with this stock? We are also going to talk about GEO Group, why Michael Burry is investing in this company, why I'm investing in this company, and why this one is a good investment but not Qurate Retail. And finally, we'll talk about, in general, the investment style of Michael Burry and mine, the differences, and whether we should look at other investors or not. So let's talk about Qurate Retail first. Why I'm not investing in the company? If you calculate the intrinsic value of the company, looking at the owner's earnings, the cash flow of the company, you try to discount future cash flows, you will see that company looks undervalued. And even to me, it looks massively undervalued. Qurate Retail is the parent company of QVC and HSN, which means that they are the largest video commerce company in the world. So they have a great business. During the pandemic, the business did well because many people were at home watching TV and shopping on QVC. But this year, things have slowed down a little because we have a recession. And most probably, if this recession continues, things for QVC, for Qurate Retail in general, are not going to be so well in the coming years. So we don't know what will happen to the economy. Now, when the Fed says that they are going to raise interest rates by only 0.50 percentage points in December, the market is happy about it because probably it's not going to cause a recession. We don't know. But looking at the economy, it seems that things are going to get worse in the coming year. Even if things don't get worse, with the current data we have, we can see that revenues of QVC, of Qurate Retail, are going down, their profits are going down. So if I, as an investor, want to invest in this company today, am I willing to take this risk of investing in the company, knowing that probably the stock market in general, and this stock in particular, are going to crash further? This is a bit risky. You may tell me why I'm investing in Meta. If, let's say, I believe we'll see a recession and things will get worse. It's because Meta, unlike Qurate Retail, they don't have such a bad balance sheet. Meta has a good balance sheet. They have very little debt. Even in the worst case scenario, I know that Meta will not go bankrupt. Qurate Retail, this is different. The company has a lot of debt. They have about $600 million in cash and cash equivalents with over $3 billion in debt. And there's much of the debt that is due in 2023, 2024, 2025. They are trying to convert this debt into debt that are going to mature further into the future. That's something good, but it increases the interest rates they have to pay. So in the worst case scenario, we have a severe recession. Qurate Retail is one of the companies that may go bankrupt. So even if it looks undervalued, because in the worst case scenario, which is highly likely, let's say 5% probability we have this worst case scenario, you lose everything. And I'm not willing to take this risk right now. The company has a market capitalization of over 800 million US dollars. And I believe it may fall further. It may fall to 500 million US dollars. Then maybe I will reconsider it and maybe make an investment. Because even when you look at GameStop, Michael Burry was investing in GameStop earlier than I. And the stock price kept crashing. He sold his position and bought again. So he lost money and then bought again. Overall, he didn't make that much money on GameStop. So even if he is a great investor, made money in 2008, that doesn't mean that every of his investments are going to be great. Coming back to Qurate Retail and comparing it with, let's say, GameStop, GameStop was trading under its book value, under its tangible book value. And the reason why the company was losing money was because of impairment of goodwill. In the case of Qurate Retail, they are not losing money. They are still profitable, positive cash flow, but the company has a negative tangible book value. The book value is positive because of their goodwill of their intangible assets, but you look at the tangible book value, it is negative. So you're willing to invest in such a company? I'm not willing to do it. Not at this price. Let's talk a little about GEO Group because I got this idea from Michael Burry, and since we're already talking about him, let's talk about GEO Group. The stock price of GEO Group is doing pretty well right now. This year, it's one of the best performing stock. And one of the main reasons why my portfolio is not down as much as the market is because of this stock. And compared to Qurate Retail, GEO Group doesn't have a risk of bankruptcy. They have reconverted all their debt that was due in the near future. This is something they were able to do because they were already repaying the debt. I'm not telling you that Qurate Retail is not doing it. They are repaying their debt, but not at such a fast pace as GEO Group. So GEO Group and Qurate Retail, even though both of them look as devalued stock, actually if you calculate the intrinsic value using discounted cash flows, Qurate Retail looks much undervalued compared to GEO Group. But there is a big risk. Whenever you're making an investment, you have to take a margin of safety. And for me, looking at Qurate Retail, with this risk, in the worst case scenario, they go bankrupt, I don't want to invest in the company. GEO Group, things are different. The company is now even heavily shorted. Maybe we can see a short squeeze. It's something I will talk about later in another video. If you're interested with a full analysis of Qurate Retail or even GEO Group, please watch it on my research platform. You can have all my analysis there along with the investing course for beginners. If you're interested, you can have a 1-month free trial. Also make sure to smash the like button so that this video spreads throughout the YouTube universe. Even if both of us are devalued stock, we have different approaches to investing. And it's because of our style. Michael Burry, he shorts the market. He shorts stocks. And he's telling us he's shorting more stocks right now than buying stocks. But we don't know which stocks he's shorting because he doesn't have to file. I will never short a stock. I'm not going to do something where the amount of money I can make is limited, but the amount of money I can lose is unlimited. This is not something I'm going to do. Why Michael Burry does it, I don't know. Maybe he likes to do it, he enjoys doing it, he knows about how to do it, but this is not something I'm going to do. Another thing that Michael Burry does that I don't do is a high turnover rate. If you look at his portfolio, he's always buying stocks, selling stocks. I gave you the example of GameStop. He bought the stock, sold it, and then bought again, even if he sold at a loss. This is not something that I do quite often. I don't have such a high turnover rate. Usually when I'm investing in a company, I'm investing, yes, for some reason something may happen, but if let's say that thing I was expecting it to happen in 3 years, it doesn't happen, it happens after 5 years, I'm willing to hold the company. But Michael Burry, he has a different approach. I'm not going to say his approach is wrong, mine is right. If you look at how much money we have, his approach is the right one. But this is not really how we measure success. So I'm not going to go there today in this video. Another difference with our approach to devalue investing is the importance of catalyst. For me, there needs to be some catalyst when I'm making an investment. But for Michael Burry, he tells us, I made a video talking about what Michael Burry wrote in 2000 on the MSN Money, on the forum there. And he talked about his investment style, and he told us there that for him, having a catalyst in the stock is not important. So he can invest in the company just because the company is undervalued without any catalyst. I agree to some extent with him that a catalyst is not as important as many people think it is. You can invest in a company, there is no catalyst at all. I invested in GameStop. The main catalyst was that there was going to be a new console cycle. I'm investing in GEO Group. The main catalyst is that they are making their balance sheet better. And Qurate Retail, according to me, doesn't have any catalyst at all. And I will compare it once again with Meta. Meta is also another stock I can say doesn't have any catalyst at all. But why am I investing in Meta and not Qurate Retail? Is because in the worst case scenario, I know Meta is not going to go bankrupt, but Qurate Retail in the worst case scenario, it can go bankrupt. So you can take catalyst if you want, or maybe you don't want to take a catalyst, it doesn't matter. But make sure you have looked at all the scenarios. The best case, and most importantly, the worst case scenario. If the company goes bankrupt, you lose everything, what do you do? Most of the stocks I have invested in have come from other people. The ideas have come from other people. I have looked at other people investing in them. Alibaba, it comes from Charlie Munger, even though I knew about the company before that. There are stocks, of course, I cannot give you really a real source where it comes, for example, Genworth Financial. I did the research on myself. I don't know anyone else investing in Genworth Financial. Anyone else famous, I mean. And this is something very common. Every investor, we talk about the story of Warren Buffett. They are following other investors. I do it, you will do it. It's normal. But we should not be following blindly. Don't just copy an investor because you trust that investor, what they are going to do 100%. You can do it, but just invest in their hedge fund, give them your money, or if they are in eToro, you can copy them. But in most cases, this is not something I will recommend. So if you're on eToro, don't just copy me alone, copy other investors too. Of course, it's up to you. But don't follow anyone blindly in the stock market or anywhere else in life. Because everyone makes mistakes. Even the great investor, Carl Icahn in 2020 lost money on Hertz. And he's considered to be one of the greatest investors in the world. If you want to learn more about how Icahn Enterprises work and why I invested in the company, I would recommend you watch this video next. Have a nice day and goodbye.